Hi guys, good morning. Good morning. So what I'm going to do here is I'm literally going to record. We're going to work through chapter 13. We're going to really cover the areas of corporation tax onwards. So pretty much, probably, I suppose, maybe for next year, I probably will record the personal tax videos, but I'll start from chapter 13 and work and make videos literally till when we finish. So this is chapter 13. As we go along, I'll get an idea of how long I'll make them. Probably 10 minutes and then take a break and then do the 10 minutes. So you're not totally sitting there all the time just listening to me. But and you'll see how, because we literally have gone through this in class. So it's pretty much a mixture of revision, but still highlighting some key points. Cool, great stuff. So let's start. We're talking about the company. Um, like I said, there is a slight order to the company when we compare it to the individual or the sole trader. When I say the individual, I mean the employee, someone who's employed and is structured via a PAYE program. So with the company, of course, there are a couple of terms here that we'll pick up again. This idea of a period of account. So think of this as the natural accounting prep process. So companies are allowed or may typically initially prepare, I don't know, a very long period, just because they're still settling. They might actually prepare a very short period. I really don't. If you like, it doesn't really matter. But what's critical, of course, is that for corporation tax purposes, the key point that I want to highlight almost straight away is that periods cannot be longer than 12 months. So in effect, we refer to these as whatever the chargeable accounting period for tax purposes are. They cannot be longer than 12 months. This is critical. So anything you calculate when we compare it to the individual, we can have longer than 12-month periods, and then we would appropriate do capital allowances over that 12-month over that 15-month or 18-month period. But we don't do that. We literally have only 12-month periods. So let's carry on. I mean, we'll see all this as we go along, so that we don't spend too much time just talking. So we'll be talking about these issues, accounting periods, the residence of the company. I mean, this is just knowledge for us to know. No one's going to particularly test you on this, but the key point is this: is the application. It's the application that's important. Two questions. Okay, right, here we are. So, key point here is that this is the general basic idea that companies will pay tax on their companies residents in the UK. Again, no one's testing you on that, but the idea is that you respect the fact that a company that is registered with Companies House is incorporated in the UK. Doesn't matter, England, Scotland, Wales. And it is centrally managed and controlled in the UK. So these general assumptions that we will hold. Um, And of course, like I say, we're dealing with these chargeable accounting periods, and we'll see them. But typically they are 12 months. It is possible to have shorter ones, but nothing longer than 12 months. The other thing that I can just highlight here, we'll see it in a second, is you can see here that what's so different to the individual here is this issue of the total income and gains of a company's is known as its taxable total profits. Remember, with the individual, we were splitting up. There were almost different rules for the different types of income and the different bands and the different allowances and the different nil rate bands, also different. And we didn't even highlight or bring in capital gains for the individual into our income tax preparation. No, we just did, because that's just a different whole animal with its own annual exemptions. But for the company, which is what I was saying, there is a tidiness to it. It all sits in the one house and all taxed at the one rate, which makes it sometimes very, like I say, quite straightforward. So what we have here, like I said, a chargeable accounting period is usually it is the company's period of account, period covered by the financial statement. So that's the period of account, and like I said earlier, cannot exceed 12 months. When does it start? Well, it starts when the business or the company is registered, typically, to start trading. That's a typical point. I mean, the next period, of course, will start when the previous accounting period ends. And it is possible that it will also start where the company might have already started trading as a company but has not quite registered. So that's when it starts. But typically, we're not really dealing with this. Our issue very much is recognizing we can't have a greater than 12-month period, and we can have short periods. And I think that's really the main thing. So typically, you would have a 12-month space, a 12-month gap from the day of registration or from the day of recognizing it as a company. Cool. Let's carry on. So again, I'm not again. What I won't do is I won't spend too much time playing around with the questions. I might just roughly do it, but you can complete it. But again, I'll throw in the key issues here. So typically, what you have, what we see, is that period of accounts. Again, like I say, it has to be split into two CAPs if the period of account is longer than 12 months. So it's always the first 12 months, and then we have the remainder of the long period. You remember with basis points, you might have to think differently about that when you're trying to find your basis points for the individual, right? So you would have done personal tax before you do this corp tax. But with corp tax, again, which is what I say, there's a nice simplicity to it. We take the first time. So here we have 1st of April. These guys went all the way to the 30th of June. 2018. Well, 1st of April 2017, I will stop here at the 31st of March 2018. That's my first period. So my first period is a 12-month period, and my second period is a 3-month period. That's my second period. So obviously these people want their year end to be the 30th of June. So post this, I know now that my accounts are going to be looking like 1st of July 18 to the 30th of June 19. So that's what they seem to be aiming for. That's the only reason you go through this sort of process. So you can do this, and they'd file, of course, one long period. But in terms of taxation, because as you can imagine, HMRC want money, so they want to make sure they can get their money based on these chargeable accounting periods. So this is chargeable accounting period 1, chargeable accounting period 2. Right, let's carry on. And again, like I highlighted, that what I highlighted earlier on is that everything kind of comes into one house, so to speak. So you have your tax adjusted trading profits. Of course, here, remember, you have your tax adjusting trading profits with capital allowances deducted and dealt with in here. Then, of course, we have interest income. This is non-trading income. So if it's not related to trade, and we'll see examples, but you can already start thinking about that. Any income that's not related to trade. So if you've typically the interest income here, I'm just again speaking out of context, it helps sometimes. When we're dealing with if you've taken out a loan to buy shares or to buy an investment building or something along those lines that has nothing to do with your trade. If you've taken out a loan to buy machinery for your trade, well, that is allowable interest within here. So that's kind of the thinking. So typically bank interest income, like interest received and things like that, yeah, that would also go in here because that in itself is not to do with trade. But we don't expect any other interest income if you're not a bank, right? Again, property income, pretty straightforward. It's what it is. A business might have some property as well in addition to what it does. It is not a property company. The business is not property, but it could have that. And why not? That income as well, you can see here is all within this context of corporation tax at whatever rate it is, all sitting under the one house. And then we have chargeable gains. Again, you have an asset, you've sold it, and you've made a gain on it. Of course, we deal with inflation within that. We'll see that when we come to this. And in your miscellaneous income, it doesn't typically come up in your syllabus, we've been told. And then these charitable donations. So you remember, of course, with the individual, we did as with companies, it's different. But think of national charities. Typically, just think national charities. Local charities, just call that advertising, really. And then local charities can go in here, but national charities will sit here. So this is technically a deduction, but you have to wait. You have to wait to make sure, and you'll see what I mean. So it is a deduction. It's there to be deducted, but does not naturally sit here within the tax adjusted trading profits. Okay, let's carry on. Right, so we have here so in terms of tax adjusted trading profits, there is absolutely nothing different from when we were dealing with the individual. The key point here is we cannot, we only want to allow for things that are wholly and necessary for the organization. We will not allow personal related expenses to go through. So where are we? So here we are. So we have net profit, of course, we have disallowed expenditure, and we have of course we have capital allowances, deduct those. Yes, so when we say private use, so when I meant, sorry, just to be clear, when I said no private use, what I meant, it must be business related. But of course, individuals, if you like, individuals, if they have a private use, it's no problem. We will tax them. Become, if you like, they'll get their class 1A benefits. So for us, it's fully allowable. We can expense all of those. Um, but it really doesn't. Again, it's not going to escape. We can fully put through the expenses, but the individual will be assessed based on a class one on the um, class 1A benefits. Right, okay. I think, like I said, what I'll do is I'll just finish this. It's already 10 minutes. It goes so quickly. This is the thing about these things. Capital allowances we deal with as normal, 12 months. If you like, we're not restricting any private assets or anything along those lines. All the assets belong to the company, so all the cars or whatever it is we're dealing with, the individual will receive that benefit. Dividends, of course, you would expect that this is an appropriation of profit, so you cannot allow these deductions. Of course, we must take out any, if we have interest income that's not to do with trade sitting in our trading, we need to take it out and put it in the right heading, which was to do with interest, right? And net that off. So I'll just look through this. Again, I'm not going to, I mean, you have this question to do, so please do it. I'm just going to talk about it, and then you will, that you deal with it, and we'll take a break, and then we'll move on to the next area. So what we classic again here, typical idea is we're going to start off typically, remember, your profit before tax, and then adjust to kind of deal with things. So a couple of things here. This is fine, of course, that's revenue, cost of sales, gross profit, interest income. We need to technically deduct this. This is not trading, it is interest income. So we will create a separate column, as you saw earlier up there, under interest income. So this has to come out. This has to come out. As usual, like I said here, depreciation, we have capital allowances, so we need to add this back. Right, and then we have here storage into this is perfectly allowable to do with trade. Let's look at the motor expenses. So motor expenses, note 1. Key point here is motor expenses relating to the higher cost of a car. Remember, the higher cost of a car will depend. HMRC do not allow the full higher costs if the engine, if you like, is greater than 110. And so you have your engine is 145. So only 85% of those costs are allowed. This is for the person and for the company. So just remember 85%, 15% is disallowed. They've put through everything. This is higher. This car is not on their balance statement of financial position, by the way, if you're happy with that. This is totally irrelevant whether the car is 75% business use and 25% private use. This occurs when we're dealing with the individual, yes, the sole trader, and then we would, if you like, apportion the capital allowance so that only 75% would go through, right? But this is not the case here. This car is a higher, this is a, or so 75% of the costs, whatever it was, but this is not that situation. There is a private use here, so there is a private benefit to receive. Okay. Let's look at the next one. So here we are. Let's look here. So we have here note 2, miscellaneous expenses. So what do we have here? Subscription, perfectly allowable. It's trade related. Contribution to a national charity. This is a QCD, so this has to come out. Well, when I say come out, added back, and then it can sit as a qualifying charitable donation, but it is not a natural occurring trading expense. Gifts of food are never allowed. So bottles of wine, doesn't matter if they're bearing the company's name. NO, no. Company pens, fine, and these are allowable as well. So we need to add these two things back, the food as well. Where are we? And then we have here the repairs, redecorating, that's allowed, and the forklift servicing costs are allowed as well. So these are all repairs. Yes, the repairs, redecorating is repairs, and servicing costs are repairs as well. And then let's look here. So the final issue I believe here was to do with these staff wages. So they've put through accrued bonuses. Now, as you can imagine, it is when they are paid. We talked about this even for the personal. So remember that it's when they're paid the bonuses are allowed to go through. I mean, all they're literally doing here, right, is inflating their expenses sheet. So we need to add these back. We cannot deduct these. And capital allowances are what they are. We deduct those afterwards. So have a go at this and look at the answers. If there are any major issues, I doubt it. And please come back to me. Yeah, great stuff. And I will see you in the next set of videos.